Hi, everyone. It's Mrs. Simonson. We're continuing on to Chapter 5. This is going to be very similar to Chapter 4 in that we're going to analyze transactions. The transactions in this chapter are the ones that affect revenue, expenses, and withdrawals. The big idea here is these are called temporary accounts. They're temporary accounts because they're part of owner's equity. And we're going to look at the difference between permanent accounts and temporary accounts. The temporary accounts have a zero balance by the end of the accounting period. And keeping in mind also that our double entry accounting debits are equal to credits, and nothing has changed there. So I'm going to jump into section 1, and that's where it goes into the relationship of owner's equity. And it wouldn't make a lot of sense if you put every single transaction of revenue and expenses into owner's equity. Owner's equity would just be this account that's huge and has thousands of transactions in it. So what we're going to do is we're going to add new accounts for revenue, expenses, and withdrawals. And so that we can actually see what the net income is or net loss instead of just lumping it all into owner's equity. So just like we talked about before, owner's equity, the things that increases owner's equity are investments and revenue. The two things that decrease owner's equity are expenses and withdrawals from by the owner. And so we're going to look at these accounts and we're going to divide them up into an accounting period. And so most of the time they're going to use a month for that. So what is a temporary account? If we look at the definition, if we hover over it, it's just an account like the others, but we're going to capture the information in there. And at the end of the month, and it's about chapter 10, we're going to transfer those temporary accounts into capital. And so why are we doing this? It's just easier to see what we had in revenue and what we had in expense instead of lumping it all into owner's equity. At the end of the month, we're going to zero balance, so we're going to transfer it. So that's part of the definition of a temporary account, is that it starts each new accounting period with a zero balance. And so they have some T accounts here. Here's an example of utilities expense. So you can see in the T account we had telephone expense, electricity, and so we had almost $8,000 in expenses. Okay, sorry, little interruption there. So we have this $8,000 in utilities expense. And as we know, expense decreases capital. A decrease on capital is on the debit side. So it makes sense that an expense would always have a debit balance, because when we transfer it, we're going to put it on the debit side of capital in order to decrease capital. So we move down here and we talk a little bit about permanent accounts. So what's a permanent account? Permanent account is basically asset, liability, or owner's equity. So the accounting equation. At some point, a permanent account could have a balance of zero, but it generally ends the period with its balance and it begins the next period with the same balance. Like you wouldn't want to have a cash balance of zero or a capital balance of zero because your business would be hurting. So although like an accounts receivable or something else like that might have a balance of zero, the big accounts wouldn't. Whatever they have at the end, like for this example right here, furniture, at the end of the month it had $28.75, and so of course in the next period it would start with that balance, and kind of signified by this 2T accounts here. So what are the rules of debits and credits? And I have a new half sheet handout, and on one side is what we've looked at before, and then on the other side is now this new capital and how that's going to transpire. So the capital is the same. Credit side is the increase side or the normal balance side. Debit is the decrease side. And why is that? Because capital is on the right side of the equation. So we're going to look at the rules for revenue, expenses, and withdrawals. Revenue, we know, is an increase to capital. So revenue generally has a credit balance. Its normal balance is the credit side. It makes sense when we transfer it. We want it to increase. So it has the same rules as capital. And here we have this little example of revenue, and it's coming here. We're going to actually transfer it at the end of the month into capital. The decrease side is going to be on the debit side, and the increase side is on the credit side. Here's a revenue account. They're calling it fees. Not my favorite title for a revenue account, but it's actually odd to have an opposite side. Like, how would you have a deduction? Maybe like a return, but that's not in a service business. We don't really have returns, but generally you're just going to have credits in your revenue account. Expenses are going to be just the opposite. An expense we know decreases capital. So the increase side is going to be the debit side. The decrease side is going to be the credit side. Normal balance is going to be on the debit side. So here we have these two coming off of capital. Here's an example, advertising expense. We have two debit transactions, a 400 and a 200, and a credit balance. And again, like, you really don't have a credit balance. You either incur an expense of doing business or you don't. Like, it might be a mistake or something if you'd have a credit, but we'll talk about that a little bit more. And then finally, withdrawals are going to be identical to expenses. They decrease capital. So a decrease to capital is a debit. So that's a withdrawals increase and normal balance side. And the credit side is going to be their decrease side. This is a new account. Like when we'd see the W. Smith, capital, now we're going to have a second owner's equity account, and it's going to be their withdrawals account. And that's kind of how you see it titled in accounts. So this is kind of my half sheet that I'm going to hand out to you. And I think it's really helpful when we're trying to get these three new accounts done. So that's it for section 5.1, and look for the next video for 5.2.